Hi everyone, good morning, good afternoon. Welcome to another strategy update from Helix. Today we are going to look at the overall macro landscape and how it's evolving, but we want to look at the oil market very specifically. So, what was happening for the last 15 years, I can say, since the financial crisis, then we had a spike in oil prices. And after that, oil has been largely, it has been moderate in terms of its impact on the macroeconomic conditions. We had a little bit of a oil shock in 2022 due to the conflict in Ukraine. There was a little bit of a shock at that time, but this was largely to do with supply chains being impacted and thereby oil prices edging higher at that time. Now, what is happening is on one side, the US administration is dropping targets for renewables, actively pursuing an oil agenda, drill baby drill, as we call it. And then on the other side, in fact, they've tried to dilute some of the environmental regulations so that oil drilling and related exploration projects, etc., can go on faster. On the other side, we have conflicts that are escalating, particularly the one in the Middle East. Why this is important is, there's this narrow portion in the Middle East, in the Gulf, where a large number of oil tankers pass through, and thereby, if the conflict escalates, then it forces oil price to go up, and we are already seeing that in the market. Now, if I look at CL1, the crude oil futures, since about June 2nd, we've been on an uptrend. On June 2nd, we were at 62.19. We are right now at 73.7. Right now, very specifically in the last 1 week, of course, there was a contract switchover that took place, but if we just exclude the contract switchover and then look at what is happening, basically a steep climb in oil prices, which directly has an impact on all of the financial markets. So that is something that we definitely need to consider from a nuanced perspective, how it's going to impact the bond markets, how it's going to impact the the stock markets, how it's likely to impact other commodities and the corporate earnings as a result. So for professional investors and institutional investors, you understand the nuances of the market, the correlations and the complexities of risk modeling. So today's discussion will likely help you further. Maybe it will add a little bit of impetus to whatever work that you're already doing. So a little bit of granular insights which can help you do your job in allocations and hedging strategies. For individual LPs, consider this as a briefing that you can use on the sort of thinking process for your longer term investments, shaping your investment strategy. And what I'd like to do is to kind of break down complex dynamics and present it in an easy way so that it is kind of actionable insight, which can help you grasp where the risks are and where the rewards lie. Right. So let's look at the macro outlook first of all. The overriding factor that we need to look at is the US's involvement in the Middle East. So far, there was posturing, but no direct involvement. Now there is direct involvement, which means that the conflict can escalate further. And this doesn't stop with oil alone, and it has a larger impact all the way through. One of the immediate ones that we see is airlines that are either canceling, rescheduling flights into the Middle East because they are relying on the Iranian airspace to fly into the Middle East, to fly into Asia from Europe, etc. So there will be some changes. Obviously, these things happened even during the Ukraine war. Even in the past, there was no-fly zone which was created. So airlines will try and change this. So your holiday plans could also be slightly impacted by what is going on right now. This intensification of the conflict, it has multiple manifestations. One is there is supply disruption. First of all, oil supply through that you know through the Gulf in the Middle East, right? So that is one major one. Secondly, what we also have to see is whenever this kind of a situation happens, um, a dollar flows into the dollar, uh, safe haven flows into gold. These are sort of factors that can put pressure onto the equity and the bond markets in general, right? So investors require certainty. Investors require a certain level of, I would say, a stable policy, a stable geopolitical situation, which is not the case right now. So the market's reaction to any further escalation, or in case good things, de-escalation, which is which is also likely to be considered. So in both of the cases, it can be significant. Though some of these can be swift, but it can be quite significant. So one of the things we want to look at going forward is we want to look at the purchasing managers index. How it's almost a near real time indicator of business sentiment. And uh, what we are seeing currently is that if I kind of break this down, um, there are strains across the globe, right? Not a single market that can say that it is growing unhindered, unhinged kind of a situation. Why is that? Number one, the unnecessary agenda of tariffs. I say unnecessary. What Trump wants to do is nice, but he is doing that in a way in which he is antagonizing his trading partners. You can't achieve anything by doing so, right? However big you are, you're not going to be able to achieve your objectives by antagonizing everyone around you. Antagonizing everyone around you. So that has had a clear impact on PMI across the world. Everywhere we are seeing the impact. One outlier where we are likely to see um, kind of growth is the Middle Eastern economies, right? If oil price starts going up, then the Middle East is going to get richer and richer. So that is something to definitely look into. Europe and UK, we are seeing the signs of slowing growth. I wouldn't call out a recession. I wouldn't call out a probability of that, but there are signs of slowing growth, and central banks are already cutting rates. We saw that with the Bank of England. Um, The PMI data that comes in later this week, uh, it will start giving us more input in terms of how this plays out. Is there a stagnation sort of a situation? And we also look at the Q1 GDP numbers for the UK, which is something that will be also helpful for us to kind of understand where it's going. The overall takeaway for me, right, running a hedge fund in this kind of a situation is really, really tough. There is high uncertainty. Markets are pretty much, I can say, on the edge, reacting very swiftly to headlines, which is a risk in itself, while simultaneously trying to catch up on the underlying economic trends, right? So it's not really you know, let's say a sort of a strategic move anymore. We are seeing a number of tactical moves taking place at any point of time. Now, going into the oil market very specifically, uh, we are seeing what we call as the geopolitical premium, right? So, is the futures giving us an indication that there is a geopolitical premium? Yes, of course. And the discussions and basically a disruption in the Strait of Hormuz, which is that Middle East, in the Gulf, in the Arabian Gulf, there's this narrow portion largely controlled by Iran, and that can give us anyway like $10 to $12 price difference if there is a disruption over there. Uh, the market is already pricing in the risk. So if you see the futures, yeah, there is a difference, and uh, as you go further out, you start seeing how the fundamentals are being taken into consideration. So for about 15 years, what we did was we took crude oil as one of the data point, but not as an important data point. We kind of kept it at the side. Now it's more relevant, and we have to definitely look at it. Um, while on one side there is an energy transition that is ongoing, including the US, right? While Trump wants to say oil being the major driver, uh, looking at various US states and California very specifically, energy transition is definitely underway. It is material. It is taking shape in various states in various ways, right? But given all this, we are only looking at oil being used for energy, which of course is a big usage of energy. But oil is also used in producing plastics, in producing chemicals, in lubrication, in various additives that are used in the construction industry, etc. Right. So, looking at that, the use of oil is not just to fuel your car. Many of the parts that go into making your car is also from oil. So a shift in the oil price is going to impact us in a number of ways. So then looking at OPEC and what is happening over there, the uh, the overwhelming stance has been so far to kind of create supply cuts because the oil demand was already going down. If there is a blockade in the Strait of Hormuz, the OPEC could take a position to enhance supply, right? So there are other OPEC partners who could enhance supply. Uh, Many of the Middle Eastern states would be impacted um, by a blockade in the Strait of Hormuz. So as far as I can see, short-term volatility is definitely there. Um, if the tensions kind of reduce, then we will likely see that the fundamentals will reassert themselves. But if the tensions don't um, diffuse, kind of escalates any further, then uh, in fact overall global oil demand was not growing at the expected phase. So there is a good chance that we will catch up during this year. So going forward into next year, if tensions continue, then you're likely to see more impact on the oil. So as of now, expect anywhere between $10 to $12 kind of impact uh, in oil pricing. So that can then translate into higher prices of commodities, higher prices of fuel, um, your general housing weekly shopping basket can go up. So these are to look at, but current opinion right now is mainly driven by fear. It's mainly driven by fear. Risk is real, but in the absence of a real disruption, we can't say which way we will go right now. Um, if there is any drastic price surge right now, it will likely correct itself in the sort of medium term. Right now, let's look at corporate earnings. Global GDP growth for 2025 slightly weaker than 2024, right? Possibly slowest global GDP growth since the financial crisis, right? Uh, that is something to definitely consider. Why did this happen? A lot of factors, but largely a major contributor to this is unnecessary tariff nuisance, right? Um, the the U.S. economy, while it is kind of weak, but it remains solid. Fundamentals remain solid. So I'm not writing off the US. It needs the right leadership, which it clearly doesn't have. Needs the right leadership, the right kind of messaging, and the right kind of posturing to its largest trading partners. Then the US economy has a very good chance of growth and likely to come out much stronger because all of the fundamentals are in there. But uh, we've had uh, in our days and weeks and probably months of uncertainty, manufactured crisis, right? Europe has been facing weak growth, including the industrial Germany, right, facing some weak growth. Uh, Emerging markets facing downgrades due to the trade tensions. India strong with domestic consumption, right? So where there is domestic consumption that's really strong, things are okay, right? Middle East and North Africa likely to see strengthened growth primarily because of the oil activity. Uh, the, the trade and tariff barriers are primarily likely to increase the input costs, and I think that is where it will squeeze the corporate margins. Um Looking at year to date, S&P 500 corporate earnings so far, 13% growth year on year, resilience, broad-based resilience, I can say, uh, but ma- but major part of this 13% growth came from large tech firms, right? Particularly AI, strong demand there is there, but likely look into industrials, healthcare, financials, and materials to show the real impact going on, right? Now, how is the ecoeconomics thesis in this kind of a situation? Uh, there is immense opportunity and there is significant risk, right? Let's accept both of it. The outlook is evolving, and at the same time, there is urgency. The reason why I say these two in combination is because those companies that are able to implement ecoeconomics see drastic differences in two areas. One is free cash flow, and the second one is return on invested capital. These are the two factors that are very, very evident so far. So, in order for this to take place, uh, the free cash flow related and return on invested capital related interventions that we see, resource optimization, so lesser amount of energy, water, lesser amount of waste means that the operating expense is lower. Leaner processes, fundamentally operational improvements that are there, reduced compliance cost because of the proactive risk management. More importantly, local supply chains, not necessarily dependent on tariff wars and whatever, right? Uh, Growing market for sustainable products and services, particularly among the younger generation. Newer markets that are opening up. Uh, Willingness of some customers to pay a premium, right? Because that price point advantage is there for sustainable brands. Because what we see is there's at least about 10 to 12% pricing difference between a sustainable brand and other ones. Uh, Cost of capital is also lower, right? There is an investor preference for ESG focused capital. Uh, so accordingly, they are able to get a higher valuation. There is favorable lending. In the UK, we have 150 odd lenders that use climate and sustainability related criteria as part of their evaluation process. They are offering terms for lower risk and sustainable companies. Um, Access to green bonds, access to transition bonds, the sustainability linked loans, sustainability linked bonds kind of structures. So that means that there is an improved access and lower cost of capital. I mentioned supply chain in the past, but because these companies have diversified and sustainable supply chains, less vulnerable to the shocks, right? We know there are at least about 2,500 companies globally that have either dropped environmental targets, or I can say and or face environmental litigation, greenwash related litigation, etc. We track about 2,500 as part of our database. But uh, looking at this, those companies that align to ecoeconomics are not part of that list. Why we track them? We take short positions on these whenever appropriate, right? And last year we made some money on these kind of short positions. I call them sustainable idiots, meaning these are companies that have mostly it is weak business model. They're not able to continue in their sustainability journey. We for the ROIC, we particularly look at product innovation, attracting and retaining talent, and very efficient capital allocation. So that means that these companies are building more resilient, efficient, forward-looking business models. So underlying business model is very, very important. So I mentioned uh, those companies that have environmental litigation, isn't it? So last week I mentioned this very, very briefly. It's a very interesting point because ESG backlash and kind of label dropping kind of thing that many US companies have done. Other global companies have also done, right? They remove ESG from their titles, etc. Well, we also don't claim to be ESG, right? But at the same time, we work on eco-economics, which is a capitalistic form of ESG. Uh, when we see this kind of, you know, shifting goalpost, dropping these targets, vague language, etc., we see some underlying factors in here, right? Number one, very important factor that we look at is the fact that there are some high risk sectors, right? Like consumer goods. Uh, the sourcing claims are difficult to verify, very complex supply chain. Fashion, many brands made eco-friendly claims. Without the data, they've been pulled into litigation based on that. Aviation, a lot of, you know, misleading claims about biofuels, about carbon offset being one of the largest kind of scams in the aviation industry. Automobile, uh, we had in the past, we had the Dieselgate, then hybrid EV, zero emissions, many such claims that have been there. Uh, Many fossil fuel companies have tried to rebrand themselves as clean energy producers while still being fossil fuel companies. So, again, misleading claims. Uh, Financial products. Many financial products have misleading claims about ethical, sustainable, ESG, etc. Right? On an average, if you look at a ESG fund, you look at the holdings of the ESG fund, you will question yourself for reading that document. That's the nature of misleading claims which are there, right? ESG funds, ESG, ETFs, etc., pension products, name it, right? There's a there's a whole range of products in there, right? So we tend to short sell these stocks. Why do we do that? Because these companies are likely to face erosion of the brand trust, so thereby stock price will go down. So we take a strategic shot on these. They are likely to face penalties. Uh, when a company is trying to drop targets, it means that there is underlying financial distress which they are not talking about. Instead, they are saying, I'm dropping this, etc. uh, they are losing market share, and there is also the risk of stranded assets behind this, right? So I think that's all for today, where we are trying to focus on, etc., how you can shape your investment strategy. We've covered a lot today, but primarily focusing on the geopolitics and the macroeconomic challenges that we have. I'll open it up for questions. Go ahead and drop your questions in the chat. Happy to answer them, or just message me, ping me directly. Thank you.